The US economy is slowing down. Almost every single indicator suggests that a recession is unavoidable. Unless the Federal Reserve will cut the interest rates, we are going to have a recession. And that's why a lot of experts suggest that the Federal Reserve most likely will cut the interest rate in September of this year, even though that it's a horrible idea since we haven't fixed inflation yet and it's rising. It could actually hit 3% by the end of the year, and that could damage the US economy tremendously. On one side, when there is a recession, investors tend to sell their stocks dramatically in order to avoid potential losses. On the other side, if you look at the stock market today, it is growing tremendously. So, why the chances of a recession growing on one side and investors are not selling off their stocks and are not exiting their positions? Yes, there are some investors such as Warren Buffett, but if you look at the stock market, it is hitting a new record. It is growing tremendously. So it doesn't actually make sense. So let me explain what exactly is happening. Chances of a recession are rising primarily because of the jobs report. Unemployment is rising. The number of jobs that have been added in May and June are less than 20,000, which is catastrophic for the US economy. That clearly indicates that companies are firing people since they expect that there will be a recession and they have to cut their cost. When people have less jobs, they have less income, they will be able to spend less money, which is going to contract the economy. At the end of the day, the GDP grows because people are spending. If you're not spending, the economy is not growing, the market is not growing, nothing is growing, and unemployment is clearly rising. And the 73,000 number of jobs being added in July most likely will be revised. So I won't be surprised if this number will also be brought down to 20,000. And this is just the beginning. We have so much chaos in the economy. By the end of the year, or probably by next year, it is very likely that we won't be adding any kind of jobs. In fact, we will have negative numbers every single month. The second indicator is obviously personal spending. It has also been going down since the beginning of the year. First of all, in the beginning of the year, in 2025, there was a plunge. Then there was a spike. This spike was primarily because people thought that tariffs are going to increase prices. Obviously, they are going to increase prices, but there was so much talk about it in the media. So people panicked, they went to the stores and they started buying stuff because they thought that if they won't buy it now, prices are going to rise. But usually when there are increases in prices, they happen gradually. They won't happen overnight because businesses do not want to lose their clients. So they might increase prices slightly. At its peak, some of the tariffs from China went as high as 245%. So I won't actually blame the consumers for rushing to the stores and buying stuff and buying new iPhones because they thought that the next iPhone will be $3,000. I can buy it now for $1,000. Maybe I can sell it for $3,000 a few months from now. However, since then, it has actually went down as well. The next indicator is obviously the consumer sentiment, is how people feel about the market. It plunged in July of 2022, and that's because since the beginning of 2022 until the summer of 2022, the Federal Reserve was on a mission of hiking the interest rates every single press conference that there was. So many businesses went out of business, so many companies went out of business, and if you have seen the stock market, it actually crashed dramatically in 2022. The tech stocks were in such a chaos that a lot of people thought that this is probably the end of the tech revolution. And tech companies started firing people by hundreds of thousands of people. We already had one negative GDP growth quarter. And that's already a very bad sign. Because what is a recession at the end of the day? 2 negative consecutive GDP growth. So if you have 2 negative consecutive GDP growth, we call that a recession. Well, some people might say that we only had one and the next one was 3% if you annualize it over the last 12 months. But I want you to take this number with a grain of salt because that number could easily be revised. You see, whenever we do these kind of statistics, it's very difficult to have the real numbers in the beginning since you have part of the data, so you have the initial numbers and then you have the rest of the data, and then you have to adjust everything in order to include all the data that came out within the next couple of months. So this number will be revised by the end of the September, and it could actually be a lot lower. And this is just the beginning. We are having trade wars with every single country. There are a possibility of a recession still rising. Consumer sentiment is going down. Unemployment is rising. And now if the Fed will increase or lower interest rates in September, then chances of inflation will increase further, and we might have a 3% inflation rate by the end of this year. So despite all of these signs that a recession is on the horizon, the stock market is hitting a new record. It's growing tremendously. Yes, there was a plunge in April of this year because of the Liberation Day. Everybody absolutely panicked because nobody knew what's happening. We had tariffs on every single country. It was as if the entire world is on a trade war. There hasn't been anything like that since like 1920s or 1930s, since the Great Depression. But we don't see that happening ever again. The market is growing. It's hitting a new record. The S&P 500 is growing. Now, some people might say that the stock market does not represent the economy. Well, it does, unfortunately, whether you like that or not. Maybe it doesn't reflect it instantly, but over the long run, it is going to impact it. What is a stock market? A stock market is where stocks are traded. These stocks represent businesses. And we as investors, when we look at these stocks, we don't look at simply numbers. When we look at the stocks, we see money-making machines. So we value the stocks based on how much money they are making today and how much money they could potentially make sometime in the future. These are, if you simplify the entire investing, you can literally just bring it down to these two fundamental questions. So when we look at these companies, and we see that they're making less money now. How would they make less money now? Because people are buying less things. There is a recession. People are getting fired. People are getting fired. They don't make money. They don't have money. They're spending less money. They're spending less money. It will reflect in the revenues of these businesses. So at the end of the quarter, they will have less revenue made, less earnings made, which means that now they're worth a lot less. And that's why if you look at the PE ratio of the S&P 500, it is growing because stock prices are growing, but their earnings are not catching up. Since people are not spending money, that is clearly a clear indication of an overvaluation of the market. And that's why if you see a lot of people say that there is an everything bubble, that the market is significantly overvalued, and there is a lot of truth to it. So why isn't the market collapsing anytime soon? Why investors are not selling their stocks in order to avoid potential losses? Why the market keeps growing? That is the fundamental question that we have to ask ourselves. The basic or simple answer to all of that is that there is so much artificial demand in the market. That demand is being created by the government. Now, if you look at the government's spending and revenue for the last year, they spent $6.7 trillion, but they have earned only $5 trillion. So there is almost $1.8 trillion of deficit. This is artificial spending by the government. So when you have that so much artificial spending by the government entering into the economy, it keeps growing the economy. It keeps devaluing the dollar. It keeps pushing the economy. Yes, the productivity isn't rising much, but it's impossible to not grow when you have so much spending created by the government. This spending is not created by the people. This spending is not created by the businesses. This spending primarily created by the government, and it ends up in the pockets of the people or the pockets of the government or the pockets of the corporations. The government has to fix this problem because this is unsustainable. And if you look at the estimates, then over the next couple of years, it will slow down to $1.5 trillion. These are the most conservative estimates that you see in front of you. For example, in 2025, it's estimated that it will be like $1.7 trillion. However, based on the current spending that we already have, it's probably going to be about $2 trillion, maybe even $2.1 trillion, because the strategy of the current White House is that we are going to spend so much that the economy or the GDP will grow by more than 3%. Like they even put the estimates that in order to pay back for the big beautiful bill, they will have a 4 to 5% GDP growth over the next 4 years. That is not happening no matter how you look at it, but they will continue trying to do that. And the fundamental way to do that is by increasing the government spending, because nobody in the economy can spend as much as the government. So we know that in the most conservative estimates, it will be $1.5 trillion. In the worst estimates, it's going to be about $2 trillion, maybe even $2.2 trillion. So how the government will balance the budget and will fix the fundamental problem that's going through? The first option that you have is to increase the revenue. They have recently passed the Big Beautiful Bill, and they have lowered down taxes. They have made Trump's tax cuts absolutely permanent. So we want to expect the government to raise taxes the next day. So this option is not happening whether you want that or not, simply because they simply just recently, a couple of months ago, lowered taxes. The second option is to cut spending. The Big Beautiful Bill includes within itself an increase in the debt ceiling by at least $5 trillion, an increase in the military spending by an extra $150 billion, and there's so much more. So we know that the government will not actually lower spending and will not cut spending. So this option is not happening either. And that leaves us with the only third option, and that is to grow the GDP. Now, currently, if you take the $5 trillion that the government is making, that is 17% of the GDP. And it has been consistent over the last many decades. So if we want to have $7 trillion of income from taxes, we have to grow the GDP to a certain level where 17% of that is going to be $7 trillion. So if we keep spending at $7 trillion, we balance the budget. And that is $41.2 trillion. So we have to grow the GDP by 37% so that 17% of that is going to be $7 trillion, and we balance the budget. Now the question is that, do you think that we can grow the GDP by 37% in a single year? It is not happening. Even if you're the poorest nation in the world, even if you don't even have basic infrastructure, you're not going to grow the GDP by 37%. That is simply not happening, no matter how you look at it. So even if we want to achieve that within the next 10 years, we need a consistent growth of 5 to 7%. The US economy has already reached its full potential, and it only grows by 1 to 3% in the best case scenario. And the only reason that it grows more than 2% in the recent years is because there is so much borrowing by the government and so much money is being put into the economy or thrown into the economy by the government. If you take that out, the US economy will grow by about 1%, 1.5%. in the best case scenario. That extra $2 trillion is pushing it by an extra percentage points. However, we can grow the GDP by devaluing the dollar. So imagine for a moment that we are going to increase the money supply to the point where there will be so much money in the economy and your income will grow by 100%, just hypothetically. So you're making $100,000. By increasing the money supply, now you make $200,000. Now you feel that you got richer. You feel that you made a lot more money right now. But on the other side, inflation is also going to grow by 100%. So even though that you are making $200,000, prices have also increased by 100%. So yes, you make more money, but you can buy the exact same amount of goods. And that is probably the strategy that the White House is pursuing right now. In fact, Donald Trump mentioned it multiple times that the dollar is too strong and we have to keep devaluing the dollar. He simply said that so many times. So I'm not simply putting words in his mouth. He literally said that. And that looks like the only option to grow the GDP to the point where we can actually get or extract $7 trillion out of taxes to balance the budget. And that is the strategy that they will continue doing. And the best way to do that is to increase the money supply. One way you can do that is by borrowing trillions of dollars and spending it. On the other side, you will lower interest rates to the point where borrowing money will become much more cheaper and the value of the dollar will go down. And the value of this debt will also decrease dramatically. And over time, you balance the budget. Now, the government does not have to bring it exactly to $7 trillion. All that the government has to do is to bring the deficit to 3%. Currently, it's $6.5 trillion. So we're looking into about like $1 trillion of deficit. And that is a real possibility over the next 5 to 10 years. That could even happen during Trump presidency. Very unlikely, but there is a possibility. But most likely it will happen over the next decade. And that's why you see that a possibility of a recession is growing, but investors are not willing to sell their stocks because they're expecting a very high inflation. Now, investors don't look at the inflation data that you see, like the CPI data. Inflation, the investors, the professional investors, look at everything from a whole completely different perspective. They know that inflation today does not include within itself asset prices. It includes a bunch of goods and products that they measure it the way they want to measure it. It does not include, for example, house prices, stock prices, which is why they look at the money supply and the real value of the dollar, and they decide whether it's better for them to have their investments or their money in assets, or it's better for them to sell their assets. So if you look at it from that perspective, you know that asset prices are rising dramatically. All you have to do is to take a look at house prices. You see that they have grown by about like 50% over the last 5 years. And look at gold prices that increased probably by 100% over the last 5 years, if I'm not mistaken, or probably even more than that. And as long as the government will continue devaluing the dollar, real asset prices will continue rising. And that is probably the best way to protect yourself. Now, if you're not a professional investor, you can go with very safe assets. I'm talking about gold, and if it's stock market, then we are talking about the S&P 500. But at the same time, there is an AI revolution happening right in front of our eyes. And some of these tech companies won't just be protected by from inflation, but also they will grow tremendously. So you're between an option. Either you are going to keep cash and inflation will eat away your money, or you're going to be invested in assets that will grow alongside the real supply of money and will continue rising. Otherwise, you will be a loser. And then there is a third category of real investors, or really smart investors, I would say. At the same time, they're protecting themselves against inflation and are investing in the best possible stocks or the best possible companies that will at the same time take advantage out of the AI revolution that's happening in front of our eyes. And these people won't just see their assets increase by the same percentage points of inflation, but rather they will profit enormously out of it. So choose what exactly you want to do here. And that's why the stock market is not crashing. And that's why the stock market most likely won't see any kind of a huge crash.